Welcome to this month's monthly Market Smart summary. All the numbers we discuss and view in this month's Market Smart is updated till end of April. It is interesting to see how the narrative has changed from a more transitory inflation to a stubborn inflation. South African inflation continues to remain high and very sticky, and in April came in higher than expected at 7.1%, while 1 year ago inflation was about 6.5%. So food and non-alcoholic beverages continue to rise and remain a key driver of the high inflation. Of course, we also continue to import inflation, adding to the pricing pressure, and we continue to see this at the factory gates, especially considering the latest PPI numbers. It is believed that Europe and the UK may only hike rates by a further 25 bips, and the US is said to consider additional economic data before the Fed will make a further decision. In South Africa, we saw the prime interest rates increase from 6.5% in May of 2022 to a staggering 7.75% now in April. So rates are now at the highest level in 13 years. A 1 million rand bond repayment would have cost you 7,700 rand in September 2021, and while it now costs 10,493. This means South Africans have had to pay more for bonds, more for car installments, and then adding the increase of food, fuel and electricity with minimal wage hikes. The question looms whether the ongoing cost of living crisis will become even worse. PMI numbers, the numbers indicating growth in economic activity, have been positive and above expectations for the US, Europe and the UK. The PMI numbers are broken up into services PMI and manufacturing PMI, and it was specifically the services PMI number that we saw increasing for these economies. In the US, the JOLTS, or the Job Openings and Labour Turnover Survey report, is a very good economic indicator which provides more insight into the labour market dynamics. And the number for the job openings is decreasing, indicating the possibility that the labour market is actually slowing. Now in South Africa, the macro conditions continue to deteriorate. The SARB has indicated that the current load shedding situation may reduce the GDP growth expectations for SA by 2% for 2023. Now we saw the rand close at 18.26 to the US dollar at the end of April, while a year ago the US dollar would have cost you 15.62. But the positive takeaway is that many private companies are seemingly on track and on budget with the renewable energy projects that they are currently busy with. Now, some commentators are therefore seeing a light at the end of the tunnel, though only in 12 to 18 months' time. Moving on to asset manager views. Local fixed income managers recently shared their views and believe the outlook for SA bonds remain positive. Given the current entry yield of roughly 10 to 11%, it's very attractive and historically have resulted in an average return of 12%. Fairtree continues to hold on to their commodity positioning after the recent China reopening, and they remain positive on base metal companies, fossil fuel companies, and are also very positive on oil. Now, on the property front, Esfikile believes that most balance sheet risks have subsided significantly for the local listed property companies. Load shedding continues to provide negative sentiment, though also a buying opportunity. They believe the local listed property sector provides good value, and they have the distributable earnings yield for the sector at 11.8%. Considering the offshore assets, we look at Catalyst on the global property side. They believe the global property sectors or counters that they hold are well positioned for the opportunities arising. Now, these companies have robust balance sheets and they currently prefer US industrials, European towers, and the likes of US manufactured housing. Now, we'd also like to feature then our optimal growth model portfolio. Every month we feature one of our model portfolios and we try and give you feedback in terms of the 4 investment pillars of outcomes-based investing. Now, when considering the outcomes of the outcomes-based model portfolios, we first need to consider the rolling investment period. This specific model portfolio is measured over a rolling 7-year period, and considering the stated outcome that we put in place, it actually managed to deliver well. If you invested 100 Rand in this model portfolio 7 years ago, it would have delivered 185 Rand, while the same 100 Rand would have yielded 152 Rand invested in the CISA category. From a consistency point of view, it is difficult for a fund in the category to deliver CPI plus 5% over a rolling 7-year period. And historically, the data shows that this sector only managed to do so 33% of the time. Our model portfolio managed to improve on this number, achieving CPI plus 5% target at least 53% of the time. Our third pillar is preserving capital against inflation, which this model did very well. And the fourth pillar is risk management. Now, traditionally, risk management or risk metrics such as standard deviation could have been considered, which compares very well to the CISA category. But looking at an outcomes-based investment, you would like to ask yourself, what's the chance of my client not achieving your goal? That is, after all, a bigger risk. Now, this model portfolio states that there's a 20% chance for a portfolio such as this to not achieve inflation over a rolling 7-year period. And considering the live and back-tested track record of this model portfolio, we can say that this portfolio did very well in terms of risk management. Let's end off with an interesting number, 2,383. Have you guessed it correctly? This is the number of crypto coins that have failed since 2013. For more on these interesting numbers, view our full Market Smarts document now. We highlight the return numbers of our model portfolios and our CIS funds, as well as the CISA sectors and market sectors. Thank you for watching. Follow us on LinkedIn and subscribe on our YouTube channel for more informative news and videos.